You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it's Education Wednesday once again here on the network. And I love every day of the network because every day brings something different. We have, of course, crypto and the option block on Monday. Tuesdays, we get a chance to delve deeply into a wide variety of perspectives, and you folks get to pick their brains with our pro Q&As here on the network. And then, of course, Thursday is TWIFO, This Week in Futures Options, another dose of the option block. Friday is oddities, so we get weird. We also have volatility views, so we dive into vol views. But Wednesday is a unique beast. It's our education-centric day here on the network. And I know for a lot of you out there, this is all new stuff. In fact, we're going to get into some of that in a little bit. That's really shaping the way things are happening out there in the markets right now. And it's a very fascinating thing to observe and discuss and analyze. So Education Wednesday, perhaps these days, more important than ever. So make sure, I know a lot of you tune in to boot camp. Make sure if you haven't done so already, make sure you add the full network because you're missing out on a whole bunch of other content throughout the entire week. We will keep you engaged on the options front on freaking every day of the week, pretty much multiple times a day. Of course, you're also missing out if you don't subscribe to the network, the sister show to this, which is Options Playbook Radio. Got a great huddle episode coming up a little bit later today on that one. So stay tuned for that on the network. And of course, if you want to listen live, ask questions, you can join the coolest secret club in options. TheOptionsInsider.com/pro is the place to go to learn more about that. And wherever you're listening to this, it's on every platform under the sun. Then make sure if you like it, keep rating and reviewing. It helps all these new folks we're going to talk about a little bit later. Helps all these new folks continue to discover the program. And there are a lot of them out there these days, and they need a lot of help. So we're happy to provide it. And then also, again, keep those questions and comments coming in. At the end of the day, it is your show. You guys get to dictate what we talk about here on the show. So if you have something that's burning a hole in the old brain pan saying, I don't really get this, or I'm fired up about X, Y, or Z, hit us up. Let us know. If it's interesting, maybe we'll talk about it here on the show. And speaking of interesting, he usually is. I can't guarantee it. Let's see if he's interesting again this week. He is the black-headed one himself, Mr. Dan Passarelli from Market Taker Mentoring, also the author of one or two or half a dozen options-oriented tomes. He is Mr. Dan Passarelli. Mr. P, welcome back to the program, sir.
Hey, it's good to be back. I can't promise interesting, but I can promise strikingly good looking.
Ooh, sassy and indeed sexy over there. Yeah, he's a bass player. He's a rocker, after all. You know, you got to expect a certain degree of sex appeal going on over there. Because, you know, what's the old saying? The ladies love a bass player, right? They can't get enough. Can't get enough.
I've been told I have a face for radio. I'm not sure what that means, but...
A face for bass, perhaps? You know, guy stands in the back, kind of plucking away.
Right.
At least it's not as bad as the drummer, right? Spinal Tap, they kept killing the drummer. They kept the bass player alive. So at least you're one notch above that, sir. But, you know, you've been busy since last I chatted with you, sir. You had your big mastermind extravaganza here in Chicago. I'm sad that I missed it. I got, busy towards the end of last. I was looking forward to coming down and meeting some of your masterminds over there, because those are always fun engagements to talk to people and see what they have on their brain as well, because it's usually insightful for what's going on. So any interesting highlights you want to share with our audience from the week-long mastermind session, sir?
Oh, I know, Mark. You're too important to come and visit the little people.
I am a pretty busy guy. And may I also say, strikingly good looking as well. You had a lot of beauty on the show this week. Who knew? Ladies, watch out.
Yeah, actually, the mastermind was great. We get a small group of some of our top traders, and we all trade together for 3 days here in Chicago, down on south of South Street. We went over to check out the new CBOE building, which is amazing. Oh, my goodness.
I haven't even been in that. That's interesting.
Yeah, I mean, it's ridiculous. Just like, it's incredible. Like, we went up into the offices, huge area.
So that's the one in the new post office here on Canal, right?
Yeah, exactly.
So you were right down the street from our studios. We're on Canal.
Oh, yeah, that's right. The rooftop is amazing. Like just like a big green space up there with like just an amazing garden, I guess you'd call it. So cool. But yeah, the mastermind overall was great. Traded up a storm, had some fun. We always go out to the round table dinner and the closing bell cocktail party on Friday afternoon, and it was great fun.
I'm glad to hear you had a good time. Just steps here from the door of the studio. But meanwhile, it's time for us to keep on rolling and dive right on into some basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, pull in, prepare to learn.
All right, everybody, let's do it. Let's dive on into our basic training, the portion of the show. We break down some basic options concept or technique or strategy, or sometimes just trend in the overall option space, and explain what's going on and perhaps how you can incorporate it, or sometimes how you can avoid it in your portfolio. And today's discussion, it falls somewhere, I think, outside of that spectrum a little bit, but it's something that's been weighing on me for a little while, and we have a poll live right now. Again, a lot of you asked us to bring back our options questions of the week over there. At Options on Twitter is where you can find them, listeners. And so we have done so. A lot of you have been having a ball with those. A lot of interesting data coming out of that. And so we posted a poll this week, our question of the week. And the results, I know this implicitly from doing shows like this. I know there are a large number of newcomers to the options market. I see it in the options volume. The data's all around us confirming this. But I think when you see it in your face, it's a little bit different. You see the raw numbers coming out of our poll. It puts it in a little bit more stark relief. Our question of the week this week is, we've seen an explosion of new options traders enter the market over the past year and a half. So it seemed like a good time to ask the question, quite simply, when did you start trading options? Give a little poll for our audience out there on Twitter to see exactly what their time frame is. We gave them 4 choices. Post-pandemic, so pretty much in the last year and a half. We meant GFC, post-Great Financial Crisis. For some reason, it went up GRC, so read into GRC whatever you want. But it's sometime around that 2008 meltdown we saw in the broad financial market, sometime after that. Anytime between then, I suppose you could say, and the onset of the pandemic era. The dot-com bust period, so right around 2000. Of course, when that big meltdown happened all the way through, I guess you can say if you want to extend it all the way to the GRC, what the cool kids called the GFC, aka the 2008 era. Then we had another category. So now we have a lot of pros floating around in our audience, like Dan and myself, former market makers and others. So we put that category in there as well for the old school pros out there. And Dan, right now, the numbers are breaking down with the leaders are right after the post-Great Financial Crisis, so right around the 2008 timeframe, a little bit later, 42.3%. But number 2 is what really caught my eye and kind of made my eyebrows pop up a little bit. Is the post-pandemic period. How many people in the audience started trading options in the post-pandemic period? So in the last roughly 18 months, almost 30%, 29.5% of the respondents picked that, sir. And then almost 16.7% said in that .com bust era. And then around 12%, 11.5% fall into the old school, the pro category, the market makers, traders of the world, and that sort of thing. So, Dan, fascinating, a little bit surprising. Again, I knew these kind of numbers implicitly from looking at the data on our network and engaging with our audience for years, but still, it is kind of different when you see it in your face like this. Do these numbers surprise you that fully a third of the audience, Dan, are pretty much completely new to the options market, sir?
It doesn't surprise me because I know that we've had such a whole bunch of people join during the pandemic and post-pandemic. And if anything, it just makes me really happy and excited. Like, that's great to see all these new entrants into this great thing to take control of your financial freedom. I mean, it's awesome. I love it. I love it that it's not just a bunch of old fogies like Mark,
You forgot the top of the show. Very sexy fogies. So you're leaving that. That's the important part out there. But yeah, it is fascinating. I knew when we started this way back in the dark days of 2007. So actually this would be pre the GRC, which is, I like a lot of our audience in the live chat are coming up with ideas of what GRC stands for. Some have said Great Recession Crisis. I like that. That's a cool one. A Great Random Crisis. I'll also accept that. We're coining new phrases here on the show this week. But when we started this, there wasn't even a network really then. It was going to be one show and it was a website pretty much back in 2007. We were building the Options Insider in mid 2006. And I thought, I know I'm going to get that guy who's, 55, 60 years old, has got maybe $500,000 in the bank. I know I'm going to get that guy because that's the options demographic. How do I get anybody else? God forbid anybody younger coming into the options space. So we thought about playing around with some new formats, some new platforms, and some new different types of media. Hence, that's why we embraced podcasting. So we were the first ever options podcast and probably one of the earliest, if not I've never seen data on the first ever financial podcast, but I'm sure there was someone out there talking stocks before we were talking options, but definitely the first option. Remember, this is pre-iPhone. This is really pre-iTunes. You had to have an RSS reader to get it. It was super hardcore early. That's also how we got at Options on Twitter. We tried to embrace a variety of different formats before they became mainstream. And that worked. We had a much younger demo than I would say a lot of the traditional options-oriented platforms and outlets out there, which has been great to see. And so we welcome this new era of traders, but still to see it, nearly 30% of people coming into the world of options right now. It has to give you, Dan, I think, pun intended, a somewhat skewed perspective on how options should work. Would you agree, sir?
I would indeed, Mark. I would indeed.
So that's going to be our subject for today. Let's call it a top 5, maybe top 5 plus list of, let's call them misperceptions, skewed perceptions, things that just aren't the way things are, quite frankly. But if you got into options in the last, let's say, 18 months, you might think are normal. So let's get into some of those things. Let's break some of those down. First off, I'll start with these. Dan, I have my own list here. I'm sure you have some thoughts on them. I'll let you weigh in on mine. Then if you have some additional thoughts of your own, additional entries, if you want to do a 5 plus, we can have at it. Number 1, something we touched on before. Again, these aren't in any particular order. Take them how you will. These are just the order that they came to us as we were coming up with the show here. But the number 1, I think that's going to leap out to a lot of people, a topic we've talked about many times on the show. Call skew, volatility skew in the call wing of your single name equity options. This is not something that is traditionally bid. This is not something that is traditionally elevated. You usually do not see it at, let alone exceeding, the volatility levels of the put wing in the same equity. Why is that? Most equity options, equity indices, all of them, they typically 99.9% of the time trade something that's called investment skew. And what is that? That's, again, look at some of our earlier archived episodes for deep dives into different types of skew and what causes them. But what traditionally happens is people are typically long these underlyings, right? They don't usually, the preponderance of people out there, the investors, don't short stocks, right? They're long them. They're buying them because they want them to go up. That's in the indexes. That's in the single name. So that causes a couple of different things to go on. People have these underlying positions now. They want to go up. When they do go up, they will sell calls against them, either to exit the position or to generate income against that. They will also buy puts to hedge that long equity position. So what happens is over time that creates this thing they call investment skew, where the puts are elevated from an implied volatility perspective versus the calls. And this is pretty much universal truth in the world of equity options, outside of some strange aberrant scenarios. Let's say you have a biotech going into a crazy announcement or something weird like that. And when it does happen, it's very short-lived. And it's not really a phenomenon you can see repeated over an extended period of time. Fast forward to 2021. And now we have not just a handful of names, but a large number of names trading for extended periods at levels where the calls are equal to, if not bid above, the levels of volatility in the put wing. This is not normal. This is not a typical phenomenon. We've just had Matt back in our pro Q&A hot seat, the Oracle of New Hampshire there from Oratz, who crunches all of our earnings data for us. And he refers to this phenomenon as the Robinhood skew. It's what happens, a lot of these smaller, newer traders have come in and bid up these options, and this is the result. So much so, it caused so much consternation. There's been a pretty heated debate in the world of options over the last 6 months about maybe we're doing this wrong. Maybe the way we've traditionally priced out of the money calls is not sufficient for the current scenario we find ourselves in, where everybody's buying these things. And so just think about that when you're looking at these options out there. This is not normal. This is not the normal scenario. Calls do not typically trade at a premium to puts in most equity You will see that in, let's say, commodities, gold, ags, whatever it is, where the concern or the fear is to the upside. That's where you will typically see a dramatic bid to the calls. And it's very favorable for scenarios, let's say, like covered calls, obviously. That's going to be a great setup for covered calls. It's also great for collars. You can sell a covered call against your underlying and buy a cheap put. That's a no-brainer. Do the collars all day long. And so it's great for situations like that, but just know going into this that this is a somewhat bizarre, somewhat abnormal, I shouldn't say somewhat, very bizarre, very abnormal scenario. If you had asked me at the beginning of the year, I wouldn't have said really this was, to this extent, would have even been possible, let alone extending, well into the year now. So how long can this continue is, I suppose, anyone's guess. But the notion that this is normal, this is how options are supposed to behave, that is not the case. Listen, so if you go in expecting that for the foreseeable future, it's probably going to come back to bite you in the near term. Dan, I'm sure you've encountered a lot of new clients, new mentees who have come to you with this belief that this is just the way options trade. What are your thoughts on this notion that people coming into the markets now just kind of expect the calls to be super juicy, sir?
Yeah, that's part of our options rater class, like our short squeeze thing, to look for that volatility smile, which is basically what I think you're describing, where the lowest volatility is the at the monies, and then the put implied volatilities or the downside calls too, implied volatilities are higher. But then normally the out of the money calls and in the money puts have a lower volatility. But with a lot of these stocks that can really take off, like we'll call them the meme stocks, they have what's called that volatility smile. And here, like, it's totally not normal. And I've been doing Market Taker I'm coming on our 14th year, if I'm not mistaken. It's going to be our 14th year next year. And, oh man, I would spend like half my time talking about how to get edge from implied volatility, how to use it, and how to be careful not to pay for options that are too expensive. But with some of these, meme stocks, some of these short squeeze stocks, I don't care how expensive they are. In fact, I literally only want to buy the upside calls if they are overpriced. So, which seems to, on the surface, make no sense, but it actually makes a lot of sense. But yeah, it's a huge misconception that that's normal. But I'll tell you, man, it's at this point in market history, it's a thing. It is a thing to observe and to look at. And 3 years from now, we might look back and say, do you remember when that was the case? That was weird. And we probably will, because since 1973, when options first started trading, you typically don't see that.
Remember when you could sell AMC 145s for $1.50 when the stock was $35? Oh, those were the days. But hey, we're living in a world. William Shatner's in space right now, so who knows? Everything's topsy-turvy. Captain Kirk floating around in the stratosphere as we speak. All right, let's keep on rolling. Number 2 in our list of things that people may expect now or think are normal in the world of options and indeed the market, but are not. Number 2, VIX itself does not typically hang out north of 20 for over a year. Of course, it got well above that level, listeners. It got well higher than 20. In fact, it spent most of that year over 30. And that is not something that is normal by any stretch of the imagination. I know, don't pay attention to some of the marketing swirling around VIX, let's say, from places like the SIBO and others where they may have a little bit of an axe to grind in getting you to trade that product out there. The long-term average is not 20. It doesn't hang out at 20. VIX usually hangs out in the mid to let's maybe high teens. So this notion that, VIX's normal home is north of 30, which is probably where it was when a lot of you entered the market for the first time. That's not normal. So the notion that, now VIX is below that, but it's below 20 again. Remember what a big deal everyone made when VIX closed below 20 for the first time post-pandemic earlier this year, listeners. That was a big deal for a lot of people because they had never seen a VIX of that level before. But people who have been in the market for a long time know that now that you're starting to get back to the levels that you could typically expect from a VIX. So the notion that now VIX is back in the teens means, I got to start loading up. VIX, maybe if it hits 15 or 16, I got to start buying these, let's say 20 calls or 20, 30 verticals or things because VIX is going to mean revert and it's going to shoot right back up. Now, we're in this weird period where we are going to see weird sell-offs and we are going to see weird little spikes in VIX. So that is something, to keep an eye out for. But in general, the notion that now VIX has come back down to a trading range that, quite frankly, is still kind of elevated. It's still a little high. And certainly if you compare it to the actual levels of volatility, the quote-unquote realized or historical volatility in things like the SPX, it is still very high. The realized volatility outside of a few sessions over the last week, it's been anemic in the S&P 500. So if you look at that risk premium, the implied volatility over the actual realized volatility, that gap is actually still very wide. And so the notion that now VIX has to go shooting back up to the upside is a bit of a misnomer. And again, something that comes from just not having enough of frame of reference, really, for volatility. Now, if you don't believe me, which is fine, if you don't believe me that VIX can hang out at these lower levels for an extended period of time, you don't have to go back that far to see the data for yourself. Just dial the Wayback Machine on whatever platform you're using to analyze your options. Go back to 2017. That was the year that the Trump administration rolled into office. And to a person on our network, myself included, the one thing we all said was, you know what, you can say whatever you want about Trump. The one thing you can't say about him, Trump is not a single-digit VIX president. Trump seemed like he was going to be synonymous with volatility. What did we get in his first year in office? The exact opposite. Volatility got squeezed out of the market at levels I hadn't seen in quite some time, and it stayed that way for quite some time. So if you tried to buy upside in VIX over the course of 2017, you did so repeatedly, you lost a ton of money because VIX hung out in single digits for a very, very long time. So this, what we're in right now, this is still comparatively elevated, A, and B, the notion that we have to go racing back up to the mid-30s in VIX again, because that's where it was when you got into the market. Not quite the case. Just look at some historical data on VIX out there. Mr. Dan, any thoughts on this? The notion of people getting into options now have a bit of a distorted perspective on where VIX actually should be hanging out for a long period.
Yeah, I mean, you're right on the money, Mark. People would say that the VIX long-term average is 20, but it's like the old Mark. I think it was Mark Twain saying, like, there's three kinds of lies, damn lies, and statistics. That's because that encompasses all the big spikes, throughout history, back from 2005 or so when they started tracking VIX for futures. It started longer ago than that. It started as an OEX vol tracker, by the way. But we're living in a VIX period that's just plain weird. Now, that said, whenever anybody gets into the market, for the first time, like, it's always weird. Like, the market is just totally dynamic. It's always changing. Like, I remember, man, back about a good, 10 years ago or so, when the market was just so darn complacent, where the market just kept climbing higher and implied volatility was slightly overpriced. And I was at a party and this dude's like, "Oh yeah, I trade options." I'm like, "Oh cool, what do you do?" And he's like, "Man, I just sell naked puts every month, and I haven't had a losing month in 2 years." I'm like, "You should consider maybe spreads." And he's like, looked at me like I'm an idiot, looked at me like, "Why would I do that? I've made money every month," and then a few months later, there's like a big drop, and I'm sure he lost his shirt. But, like, he didn't know any different than what you see. And man, I'll tell you what, that's one of the hardest things about trading is that humans are designed to see what's in front of them and adapt to that. And your brain just sort of wraps around it and thinks it's normal.
Let's see what else is normal, or at least people think is normal these days. Let's go to number 3 on our list. This is an interesting conversation. I like this out here. Hopefully, I'm looking forward to some of your feedback. What you guys think is normal in the market right now versus what you think is crazy. Let's see, number 3 on our list here, again, in no particular order, related to the volatility conversation. Just putting it out there. Stocks don't normally trade at, let's say, 1,000% or higher volatility. That is not a thing that traditionally existed. Coming into this year, if you had polled many seasoned volatility traders and market veterans and said, is this even possible, let alone to happen and exist for an extended period of time, they would have laughed you out of the room and said, get the hell out of here, kid, you're crazy. And now, of course, fast forward to 2021, and what did we see? We saw many different underlyings exhibiting levels of volatility similar to that. Of course, GameStop and AMC are the infamous ones, but many of the meme stocks got up there to levels, 400, 500, 600, up to close to 1,000 in some cases. Again, this is not a thing that you should traditionally expect to see in the world of options. This is completely abnormal. A conversation on one of our other programs out there in one of our cohorts say, effectively, this is analogous to the market makers out there. It's kind of throwing their hands up. They set their vol to 1,000. They say, hey, just stay the hell away from this because no one knows what the hell is going on out there. And that is somewhat correct. Yeah, at the end of the day, when you see vols at these levels, it means things have gotten so out of whack in terms of what anyone had modeled or anticipated versus what's actually happening out there, that it's a very dangerous scenario, quite frankly. It's difficult when the vol's at 1,000. You might say, well, I should probably just sell it. But you could easily get your face ripped off out there. And of course, buying a 1,000 vol, you need a hell of a move to justify that. So it's very difficult in those scenarios to make money unless you're a professional with a lot of capital at your disposal, being able to kind of delta hedge and do a lot of other things that are difficult for the retail to do out there. Unless you're in that very, very small niche of the options market. And you see these types of astronomical levels in an underlying, you probably want to stay the hell away. This is not something you traditionally want to trade, particularly if you're new to the world of options. This is one of those sayings, fools go where angels fear to tread. The pros are very leery of diving into an underlying like this. So if you're new to the world of options and you're routinely slinging options, buying and selling them at 300, 400, 500, 600, 1,000% of volatility, just know that that's a difficult road to do over the long run and not something even the most skilled of volatility traders would probably consider attempting. Mr. Dan, what are your thoughts on these kind of just absurd levels of vol we've been seeing out there in some of these meme names?
Yeah, not normal at all. But I would say that it still goes to fundamentals, which I kind of touched on about 10 minutes ago, I guess. Two things. One is in most cases, when volatility is really out of whack, it creates an opportunity. Generally, if it's absurdly too high, it very, very often creates an opportunity to sell at an extreme statistical advantage. And that's what all good trading is about, right? It's not about guessing right. It's not about lines on charts. It's not about anything. It's about trading for an edge, being the casino, not the gambler. So most of the time, yeah, like when Vol's ridiculously overpriced, you can just sell the darn thing. But then, I go back to what I was saying about the meme stocks, where I get excited when that Vol's high, when that stock starts taking off, because what that means is that there's been so much call buying that market makers are short a bunch of calls, and you can get the gamma squeeze on top of the short squeeze, and all of a sudden you just kill it.
Yeah, it's not the typical scenario, right, where you see, 1,000% vol, let's just blast the hell out of that. And yet, if you did that in some of these names, like a GameStop or an AMC or others, you got your face ripped off pretty quickly. So it's a challenging trade, like I said, even for pros. So at these extreme levels, don't dive into the outliers. Start it easy. It's already difficult and intimidating learning about options in a normal, tranquil market, let alone diving into some of these names. It's a difficult road to go down. And if you're just buying options at these levels, expecting the home run all the time, you might hit a couple because we're in crazy times right now. But this, again, long term, unless you know what the hell you're doing, a difficult road to go down. Let's go down here. Number 5 here on my list. Again, kind of one that people who've been around space for a little bit would probably say, yeah, that makes sense. But if you're new to this could be new to you as well. And the notion that stock squeezes are these things now that just exist, and they go on for weeks and weeks and months. In fact, right now, as we speak, our old friend AMC, one of the reigning kings of the memes, is undergoing yet another round of squeeze to the upside. How many months has this been now? It's close to a year that AMC has been getting quote unquote squeezed. Just know this as well. This is not a normal phenomenon of the market. Like, this is a little bit outside the scope of options, but still, don't expect a short squeeze to traditionally be a many months long process. What is normally happening in a short squeeze is exactly what it sounds like. A name is heavily shorted. People may think that it's shorted unduly, that the folks who are shorting it maybe have the wrong perception. Maybe they just think those shorts are just overextended. It's hard to buy that stock back, and they could take advantage of them when they start buying it, and they could kick off this spiral, this death spiral, this catalyst of upside where the shorts have to cover, and that drives it up. And so whatever the reason that precipitates it, these short squeezes are usually very short-term phenomena, usually for a session or two, maybe a week or so, two at the outset. And then what traditionally happens is the shorts have bought back some or all of their positions, and things tend to settle out at a price somewhere probably above where it was when it started, but not, the levels we're seeing right now, hundreds of candles away. And the notion that this thing can continue, and then new waves could keep coming in, and it becomes this just extended and protracted phenomenon that goes on for months. Again, not normal. Nothing we've seen so far in this year has been what you would consider normal. So the notion, you see this name, you think, I think this might be a short squeeze name. This is something I want to get into for the long term. Not probably the right way to approach that. If you think the short squeeze is going to happen, and it's a more traditional short squeeze, then it's probably something you want to prepare for a very short period of time. You want to get in, you get the move, you capture whatever you think you're going to get out of it, and you get the heck out of Dodge, and you live to fight another day, hopefully with some profits in your back pocket. The notion that, you're going to buy and hold whatever name just to ride against the shorts in perpetuity, again, the only way to describe it is not normal. Mr. Dan, sir, what are your thoughts here on this? We're just all living in a protracted, endless short squeeze, sir.
I know it is the strategy in vogue. But yeah, you hit it right on the head with the management of it. There's a lot of folks on the Reddit boards and stuff where I mean, frankly, like they say they have a different motivation than actually making money. Obviously, I think making money is part of it, but they want to buy and hold these things to shake out the short sellers and sort of take on Wall Street. And hey, man, if they want to do that, that's fantastic. But me, like my trader's mind, I'm doing this to make money, to create a profit. And these are not buy and hold strategies. Like these are buy and take your profits. And like the management is the big thing of it. Like the management's the biggest part of our options rater system. It's very, very important to get out when the getting's good, as they say.
And we're going to get out of this segment. We hit on our top 5 right now. I'm sure you guys have thoughts on this. Do you have ones you want to add to our list here of things that are perceived as normal right now, which are actually anything but normal, or maybe you have counterpoints to our suggestions, whatever that is, hit us up. Let us know at Options on most social medias, or, of course, questions at theoptionsinsider.com. Also works if you're part of the secret club. You can hit us up live. That goes straight through that member hotline. Meanwhile, they'll be speaking of the member hotline. Let's get out there really quickly and see what some of you folks have on the brain. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call. Like I mentioned at the top of the show, we have a poll right now asking you guys when you started trading options, quite simply. And it's been fascinating to watch. It was kind of the genesis of this whole episode. Right now, the post GRC, as the cool kids are calling it, is leading the dance with 42%, but hot on its heels, almost 30% post-pandemic. I'm curious, where do you fall? Go to @options, make your voice heard. You got about a day or two left in this one before it goes the way of the dodo. So you folks listening after the fact on the podcast feed can play along as well. Speaking of questions of the week, we asked you on our last show. It was hot and heavy. This was also inspired by a listener question. You listeners are just the best. You send in such great questions. This was inspired by, what was the most confusing trading strategy. So we put it out there to you, gave you 4 choices. Is it straddles or strangles, time spreads, butterflies, or other? You guys sent in a bunch of different others. I think puts, verticals, iron condors, box spreads got a surprising amount of love, which is interesting. Remember, we created this poll around butterflies, and they got 31.4% of the vote, but 45.1% of you said time spreads. It's hard for me to disagree with that. Time spreads are extremely confusing to most people out there. Straddles and strangles only getting 17.6%. So intriguing stuff out there. Keep voting at Options to make your voice heard. If you want to make your voice heard, you can be just like Dan here, Daniel Cleaver. He says, hi, Mark. Well, hello, Daniel. He says, I just got into options. Oh, here we go. He's part of our 30% we were just talking about. Welcome to the game, Daniel. Listen to our list we just put out there. Hopefully it will disabuse you of some perhaps misperceptions that are floating around in the world of options right now. He says, I've been listening to Options Boot Camp, which is an excellent show. Well, thank you. Just shows you're a man of discerning taste. He says, I've heard a lot that you should sell options when implied volatility is high, but when looking at the graph of SPX implied volatility versus realized volatility, it appears that when implied volatility is high, realized vol is just as high, meaning that there is no advantage to selling. However, when implied volatility is low, it appears that realized volatility is consistently much lower, implying that there is much more of an economical advantage to selling options when implied vol is low. Is this correct, or am I crazy? No, you are not crazy, Daniel. You've just done your own analysis to come the long way around to a conclusion that we've discussed many times, controversially, it seems, on our Vol Views program. Remember, it was probably at least 4 or 5 years ago on the Vol Views show where we had Ewan Sinclair on the show, noted vol author and trader. And he came on and pretty much expressed this exact same sentiment. He came on and said, when VIX is exploding to the upside, when it's getting up to these crazy levels, the 70s or 80s, you think you want to sell it. But counterintuitively, as you point out, that's probably the time when you may want to buy it, because that's when it's really poised to outperform until, of course, it crests and it finally comes down the other way. And vice versa, the other way. Go back again. Look at what I said about 2017. VIX hung out in the single digits for the lion's share of that year. If you bought it, you lost all your money. So VIX can hang out in those low implied vol periods. And you're right. In those moments when implied vol is low, realized vol is even lower. So you might think you're not getting a lot to sell it, but the chasm between realized and implied vol can still be, somewhere around 6+ points. That's big. We just saw that recently in the S, where implied vol was low, but realized vol was anemic. So, no, you are not crazy, Dan. And I'm glad to see you discovered this on your own. It means you're coming around. You're doing the right analysis. Keep it up. You've discovered something that some people take a long time to learn about the world of volatility. And it's very controversial. People still argue that when they hear that Ewan clip, they get angry. But if you look at the evidence, it's kind of self-explanatory. Dan, thoughts for you here on, first off, your well-named friend Daniel here. B, he's clearly a discerning man of excellent taste because he listens to this show. What do you have to say about what he discovered on his own, sir?
Right. Hey, Daniel, you're right on, but let's just take it one step further, okay? So let me ask you this. Do you think that $50,000 is a lot of money for a car? The answer is, well, it depends, right? It depends on what kind of car it is. If we're talking about some sort of, I don't know, I don't buy a lot of cars. Used Ford Escort from 1985. That's $50,000, a lot of money for that.
That's a classic. It's priceless at any price, sir. How dare you be smart?
Right. I had one of those. Stick shift, no radio. It was wonderful.
Oh, that's the good one. That's the one people are paying for now. The no radio, big dollars.
Right. $50,000 for a brand new Lamborghini, kind of cheap, right? So don't just look, when you're looking at the implied volatility, don't just look at the level of the implied volatility. Look at it just like you're doing. Look at it relative to historical volatility and relative to itself, and kind of forecast for the future. If earnings is coming up in a couple of weeks, it's probably going to go up and be elevated, right? So there's always those three things. We call that the MTM 1, 2, 3 volatility analysis, right? Step one, what is implied look like relative to itself over the past 6 months? Step two, is today's implied above or below today's historical? Step three, is there anything in the pipeline that could cause implied volatility to change in the near future? So yeah, you're totally on the right track. Just flesh it out a little bit, and you got this, man.
Now, Dan, you mentioned earnings volatility. That reminds me, I completely skipped number 4. I only did 4 of my top 5 in our previous segment. So let me hit on that right now because it pertains to earnings vol. The notion there, listeners, right now, people coming into the markets for the first time could reasonably be expected to think that earnings announcements, earnings guidance don't really have any material impact on volatility or the kind of forward movement of the stock itself. And again, I can't fault you for thinking that, because looking at the data, and we have all the data for you guys to review over there, theoptionsinsider.com. Well, just go to optionsinsider.com and go to the options news and articles tab, and you'll see all the earnings move results and earnings season reports. It's the latter ones you want to pay attention to there. If you look at all of those since the pandemic, you will see that there hasn't been a single break-even earnings season since the pandemic began. What does that mean? That means going into the season and during the season, names are expecting a certain level of movement. That's what they're pricing in from their earnings straddle. And what has come out of it, what has resulted, is demonstrably less, pretty much across the board. Now, there's been a few outliers here or there. We can always point to some name like Nike last cycle blew the cover off the ball. There's always a few of those. But in aggregate, the entirety of the earnings season has underperformed dramatically. You're talking 50-odd, 60-odd%, getting your money almost cut in half. The closest we've come to breaking even is actually the last cycle. We got it to around 84 to 86%, which again, you still lost money, but you lost a lot less than, let's say, 60-odd% like it was not too long ago. So a lot of people out there coming into these markets could be forgiven to looking out there and saying a giant name, XYZ, pick your poison. They take away all their guidance for the year because they can't possibly predict in the height of a pandemic. And they cut everything else and they report massive losses, and the stock barely shrugs and the vol comes in. That is not normal. That is not normal. Normally, if a company revokes all of its guidance and reports massive losses, the stock's going to take a hit and the vol is going to explode. And you're going to see movement and you're going to see volatility. Two things that we really did not see and have not seen since the pandemic began. So these weird, muted announcements around earnings are not normal. And you should not expect them. It does seem like, looking at the data, we were just talking about this with Matt yesterday in the Pro Q&A, looking at the data for the upcoming season, maybe that time is coming to an end. We might start seeing some outperformances out there. But in general, if you come into the markets right now thinking, earnings shrug, they don't really have much impact on what I'm doing out there because the stock doesn't seem to budge and the vol doesn't seem to budge from these announcements, you probably should take a second thought about that. Mr. Dan, I know you do a lot of earnings tradings. What are your thoughts on people right now coming into the market and just kind of saying, earnings, they haven't mattered since the pandemic, so who cares?
Yeah, I mean, earnings actually is, in my opinion, it's very important for future guidance. But more importantly, for option traders, is they present some really great trading opportunities. I'm actually having a webinar, tonight, if you're watching it live, but I'm going to repeat it a couple more times this week on our earnings trading system. And usually I'll try and create a little short link that's easy to access, but we're just inviting our audience. And so if you go to my website, markettaker.com, just go there and click on join free in the top right, and you'll get an email invitation for being part of the family.
All right, everybody. We've been running on a bit. This is a fascinating topic. We can probably talk about it for many more hours. I got a feeling, given your feedback, we're going to be talking about this again. You guys are probably going to have questions. Maybe you have a suggestion for what we should have added to our list, a number 6 perhaps, or perhaps something we should take off. You don't agree with it, hit us up. Let us know. You folks are not shy about your feedback. That's why we love you folks out there. But again, in general, the gist of what we wanted to convey to you today is that what we're seeing out there in these markets, do not expect these environments, these scenarios, these setups over the long term. If you take anything away from the show, just know what we're seeing right now is not normal! Exclamation point on the end of that. Mr. Dan, you kind of just mentioned your upcoming webinar. Any other hints or teases or fun facts you want to leave our audience with, sir? Have at it.
Oh, man, no, just, hey, keep on being you and keep on moving forward. As soon as you stop learning, it's over. The more you learn, the more you earn, and thanks for being part of our show.
There you go. Be like the great white shark, always forward, hopefully not devouring people along the way, but devouring profits. Keep moving forward. Check out what Dan and the crew have to offer over there. MarketTaker2Ts.com is the place to go to learn more. Of course, if you're in the secret club, you already heard the great huddle that Brian and I did last week. You got an early glimpse to listen to it in a week or so ahead of time. For everybody else out there, you're going to hear it on demand on the network a little bit later today after boot camp hits the network. Of course, if you want to join a secret club, they're having fun debates in there right now about what everyone's different greatest trading weakness is, which is always fascinating to see. TheOptionsInsider.com/pro is the place to go. You get all the shows we do throughout the week live. You get all the exclusive shows like the great Options Pro Q&As, as well as Options Oddities every Friday. So if you need a lot more pro options content in your life, and maybe if you think some of these things we're seeing right now are normal, then perhaps you do, TheOptionsInsider.com/pro is the place to go. And don't go anywhere. A lot more content hitting the network, and then we'll see you back here next Education Wednesday, another episode of Options Bootcamp. See you then.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.